let us start with portfolio management. Okay, so portfolio management, this chapter is divided into three parts, which is your modern portfolio theory, MPT by Markowitz. In it, we have certain things, and then we have capital market theory, CMT by Sharp. Okay, and third we have other topics. Okay, for exam, your modern portfolio theory and capital market theory by Sharp, it is very important. Okay, part 3 other topics is not as important as this two. Okay, so in today's lecture we will see modern portfolio theory by Markowitz. What will we cover today? Return and risk of a security, return and risk of portfolio, minimum risk portfolio, Markowitz efficient portfolio. Okay, 4 things we are going to learn. So how are these topics in this part? We'll see. Okay, portfolio management is the process of selection of securities for investment with the objective of maximum return and minimum risk. Okay, whenever you want to invest in a security or invest in a whenever you want to invest in a security, what you want maximum return and minimum risk. Okay, if you want the lowest risk, the zero risk, then you will go for bonds. If you want more returns, you go for market. Okay, that is your equity market. But if you want, so there has to be a balance between the two, that is more return and less risk also. So that we can do in your market, equity market. Okay, so first part will start with Markowitz modern portfolio theory, MPT. As per Markowitz, we should invest amount in more than one security to get diversified benefits, that is to reduce the risk on the basis of correlation between securities. So what is Markowitz saying? That when you want to invest in your equity market, okay, don't just invest in one security, invest in at least more than one securities. Okay, so 2 3 4 how much also you want to do, you can do, but Markowitz says you have to invest in more than one security so that you can get diversified benefit. What is diversified? That is to reduce the risk. Okay, when there are two securities, if one securities goes up and other securities goes down, your risk is managed. Okay, on the basis of correlation between securities. This correlation between securities will I'll explain it to you in the later part of this chapter. Okay, in the later part of this topic. So I said that it is more than one security, right? In this chapter, at the max we will learn that the portfolio is considering of 3 securities. So what do you mean by portfolio? Portfolio is a collection of items. Okay, you have portfolio of art, portfolio of cars. Okay, so here collection of shares is known as portfolio. Okay, so expected average return or and risk of single security. Okay, so now we are going to calculate our expected annual return and risk involved in it. So what we need to do when we invest in a security, we see that we get maximum return and less risk, minimum risk. So here they are going to calculate for a single security. For a single security, how we will calculate? So that we will see. So the first one is on the basis of past data. Okay, on the basis of past data, it is also known as ex post analysis. Okay, so we will consider the past data, the historical data of the company to predict the future. Okay, if in past the security has performed very well in the market, okay, it in future also there are high chances that it will perform better. Okay, so while we are doing portfolio management, okay, in our whole AFM syllabus, we will only do fundamental analysis. Okay, only one chapter there is which is for your technical analysis. So here we will do only fundamental analysis. Okay, that is fundamental analysis means based on your financial records. Technical analysis means based on price of the share, past price of the share. and this is past historical data, your financial data of the share. Okay, so first we will calculate on the basis of past data. Okay, so if you see, how do you calculate return? Okay, if you are investing in a security, how do you calculate return? Okay, let's suppose you invest in Reliance shares. Okay, let's assume that its market value is rupees 100. Okay, it's only for example purpose. The market value of Reliance is 100. Okay, you invest in that. Okay, now what happens that at the end of the year the price has become 120. Okay, also in between the year the company has declared dividend. Okay, interim dividend and final dividend also. Okay, so totally dividend is coming to 10%. Okay, now what is your return? Firstly you got dividend, right? Next you got your difference between the share. Okay, the market price of the share has increased, so two benefits you are getting. Okay, first one is dividend and second one is your returns. Okay, return on investment, sorry, return, that is your increase in market price. Okay, so this both return you are getting. So in what, so when you want to calculate its percentage, that is your return percentage, so what you will do, you will divide it with the actual amount invested in it. So what actual amount would you have invested? The one which you have put in at the beginning of the year. Okay, that 100 rupees will be your beginning of the year, that is your invested amount. Okay, so that is what it is written here. So D, that is your dividend, plus P1, it is your end of the year, minus P0, it is your beginning of the year, divided by P0, that is your beginning of the year. Okay, so now what do we do? Let's suppose you are investing in Reliance Limited for not just 1 year, you are investing in for 5 years. Okay, for 5 years how will you do? You will calculate individually annual return, right? Annual return you will calculate, and then what you will do, then you will take average of all the 5 years. Okay, so that you get an amount. Okay, so that is your expected return. That's what they are doing here. They will do summation, that is sigma x, that is a summation of all your annual return. Annual return is denoted by x. Okay, so sigma x divided by n. N is your number of annual return. Okay, what is x bar? X bar is your expected return. Expected return means was your average return. Okay, average of 5 years. Now there are two aspects, right? Which first one is your expected return and the second one is your minimum risk. Okay, you want minimum risk in it. So for that what will happen, we need to find what? We need to find variance. Okay, we need to find variance. So how much will, see the third one, we need what? We need risk. Okay, we need risk, we need to calculate risk. So now what I want is, what is my risk? Okay, my average return is, let's suppose 15%. Okay, what is my risk? My risk is that the 15% will go down to 10%, 7%. Okay, or so that is my risk, right? So now what we'll do, also the, if the share price goes up, or the we are just calculating here variance. Okay, how much will the expected return vary from the actual return? That is what we are seeing, that we can know, get it as risk. Okay, so what is the risk factor? Risk can go up, risk can go down also. Okay, now we will see variance. Variance means what? Deviation in actual return minus your expected return. Okay, so what we do? We do actual return minus your expected return. Okay, now what happens, you know, when you do actual return minus your expected return, it will come to 0 only every time. It is based on mathematics, okay, because you have taken an average and you are just minusing it with your annual return, okay. Yeah, that is your first return, expected return. Now when you do, some amount will be in positive, some amount will be in negative. It will all set up to 0 only, okay. Average return is what? It is your, see, I'll tell you by showing a graph, okay. See, what is your average return? Sorry, what is your average? This is a number line. Let's suppose this is 10 and this is 20. Okay, what is the average? It is 15. So this is the centermost figure, right? When there is amount here, 10 minus 15 is equal to 5. Okay, minus 5. And here 20 minus 15 is equal to 5. So the net amount will be 0 only. Okay, this is the 0th part. That's why we cannot take x minus x bar. Okay, that is your annual return minus your, this is my annual return, this is my x, this is my x, and this is my x bar, this is my average return. Okay, so x minus x bar, we will get 0 only. So what we can do is we will square it. Okay, when we square it, then we can get a good figure. Okay, then we will divide it by n. Okay, see now when we are getting this amount, it will be squared. Okay, all the calculation in this chapter will be in percentage. Okay, that keep in mind. Okay, return was in percentage, risk was in percentage. So return was in percentage, right? Now we are calculating risk, it is also will be in percentage because we are using returns for risk. Okay, so now what is happening here? It is we are doing n, right? So this is percentage square. Okay, percentage into percentage is equal to percentage square. Now here if you see 10%, okay, and 20% and 15%, so percentage into percentage, that is we are doing square, right? 5 into 5, okay, minus 5 square, that is percentage. 5% is 5% is equal to percentage square. Now this amount will be more. Okay, so what we need to do, we need only in percent, so we'll square root it, right? If you want to remove square, we do square root. Okay, so that's what it is happening here. We will do square root of variance. Okay, here there is some example given. We will not do example, we will do questions. Okay, this is the basic funda. Okay, we'll just revise the concepts here. I'll do questions in some part, okay, which is more important, but this one is very much easy. It is the basic thing of this chapter, so it will be carried forward in many of the next calculations, so we will practice there also. So here there is no need for practicing it again, so this example is cancelled. Okay, next one we'll see. So the next topic is calculation on the basis of future data with probability. We are doing the same thing only, return and risk. We are finding out annual return and risk of the security. So now it is on the basis of future data. Okay, so future data, can we be certain? Can we be certain? No, right? When we are calculating future data, there is no certainty. Okay, it can be anything. We can just get a probability. Okay, that this much amount is probable. Okay, we can get only probability. Okay, that the probability of getting this much is this percent, the probability of getting this much is this percent. Okay, so we can get only what? Probability. So we can only get what? Probability. Okay, it's also known as ex ante analysis. Okay, so you understood, right? We are getting only probability. So in past years, what we can do is ex post analysis. What we can do is we can calculate return of many years. Okay, here with future we will just see only 1 year. Okay, only 1 year. The future probability we will take only for 1 year. Okay, so how we will do, we will see. Okay, first what we need to do is, okay, for this we need example. Okay, for example, how we will do, we'll see. Okay, in question they would have given directly your annual return, sorry, directly your market price. Market price of the share will be given in question. Okay, so what we need to do is, see in the following example, we'll just directly take example. Okay, so that you can know it very much good. Okay. Okay, I'll just read the actual part of it and then we'll move on to example. Okay, we'll do example also in this. The annual return of security for each possible scenario. Calculate annual return for security for each possible scenario. Okay, how will we calculate? We will calculate, first we'll take our annual return. Okay, annual return into your probability. Okay, whenever there is probability, you will not do this, what you will not divide it with your number of years, number of annual return. Okay, in probability what we do, we just calculate it with the probability. Probability is 1, right? Probability is 1. 0.75, 0.25 is equal to 1. Okay, whatever it is a weight only. Okay, so probability is 1 only. So when we multiply it with 0.25, 0.5, 0.25, we get total as 1. Okay, in n what we do, in n, why we are doing it, the total returns of 5 years. Okay, we do it for divide by 5, we get 1 year. So here also we will get 1 only. Okay, so that's why it is only multiplied with it. Okay, so now what is my annual return? It is the sum of all probability. Okay, next, how will we calculate risk? Risk is x minus x bar. Okay, what is my x bar? My x bar is summation of px. Okay, summation of p into x minus x bar. So here there is no divide by n. So here we will multiply it with probability. We will get what? We'll get our variance also. Okay, so variance is in percentage square. We will square root it and we'll get what? We will get standard deviation. Okay, this is the basic funda of probability. Now we'll see an example. Okay, current MPS of the share is 100. Market condition can be as follows after 1 year. Market condition good, normal, bad. Probability 0. Okay, market price per share is given. Dividend per share is given. Okay, so now what we'll do, market price for the base year is given. So market price for the year end is given. So we'll do difference of it. Okay, 115 minus 100 plus 9 divide by 100. Okay, so we'll get 24%. In normal it is 12% and in bad condition it is 0%. Okay, now we'll multiply it with the probability. Okay, annual return into probability, we'll get we'll take summation of px, we'll get expected return, and expected return, annual return minus expected return is equal to your this thing, x minus x bar. Then we'll do, this will be 0 only. Okay, so next what we do, we take square of it, and by doing square the amount is more, right? Now we'll have to take it for only one. Okay, so that's why I do it with probability, the total of 1. Okay, now we are getting in percentage square. In percentage square we don't want, we want in square root. Okay, we want in percentage only, so we'll square root it and we'll get an answer. Okay, there are some notes here. Okay, so we'll read it. Annual return x percentage can be directly given in question. Risk calculated above will be total risk of security. Okay, variance and standard deviation of risk-free security is always 0. Okay, so the risk of the standard deviation of risk-free security is 0 because in the name itself it is given as risk-free. So there is no risk, so it will always be 0. Also, annual return can directly be given in question. We don't need to always take market price per share. Okay, it can be given directly in question, so keep that in mind. Next, risk calculated above will be total risk of the security. That is a standard deviation is your total risk. Okay, we assume it that. Okay, so based on this, there is question number 1 and 2. Okay, we'll just do concepts in this part. Okay, MPT theory, full concepts we'll do. Next lecture, we'll do questions of it. Okay, expected average return of portfolio. Okay, so what it is given here, that the expected or average return of, now what we are going to do is, there is a portfolio. Okay, let's say it has 2 securities or 3 securities. Okay, as Markowitz said that if you want diversify benefit, keep more than 1 security in your portfolio. Okay, we'll keep 2 or 3. Okay, so what is this topic saying is, we have to calculate the return of it. Okay, return and risk of it. So how will we take return of this? Okay, let's suppose we have 1 lakh. Okay, there are 2 securities A and B. Okay, now what we are doing, we are putting 60% in security A, we are putting 40% in security B. Okay, I am putting 60,000 in security A and 40,000 in security B. Okay, now what the return of security A is, let's suppose, see, I have how much? 1 lakh. Okay, 1 lakh. I am putting it in 2 securities A and B. How much? 60% and 40%. Okay, that is equal to 60,000, and here it is 40,000. Right. Now I calculate. In question they have given the annual return of, here it is 12%, and here it is 15%. Okay, so now what is the question asking me? Give me the return of portfolio. Okay, this is my portfolio, right? Now I want to find return of it. So how will we do? We'll take return of both security. Now we just have to do it pro rata. So what we are doing, we are assigning weights. Okay, so how much is it? 60,000 divided by 100,000, and here 40,000 divided by 100,000. So what answer we'll get? 12 into 0.6, 15 into 0.4. So my average return is 13.2%. Okay, we are just giving weights for it and getting pro rata. How much return is each security getting? Okay, from divided by the, what we are doing is, we are multiplying the weights with the return of each security. Okay, so we'll get weighted average return of portfolio. Okay, simple only. Okay, so that is my weighted average return. So that's what they have written in English here. You just need to, if you don't want the actual logic of it, just remember the formula. What is the expected return of portfolio? It is expected return of security A into your weighted of average of security A plus ER into B into weight of B plus ERN into weight of N. Okay, next, there are some notes in this part. Weight of securities in the portfolio, it can be given in question. Otherwise, weight should be based on the amount invested in each security, that is the initial cost or investment or opening market value. Okay, so how do we calculate weights? We will calculate the weights based on the amount invested in it. Okay, at the beginning of the period and not at the end of the period. Okay, at the beginning of the period, what are the weights we will calculate. Okay. Next, there is an example. It is very easy. So I'll skip it. We will do it in question. Next, risk of portfolio. What is the risk of portfolio? So now what we did, we calculated portfolio return, okay, by doing simple average of it, okay. So in return, there is nothing, okay. In return, we can do just weighted average. But when we are calculating risk, in risk, we need to calculate the correlation between them, the relation between the securities. Okay, the securities we are having in our portfolio, security A and B, okay, we need to calculate the relation between it. Okay, how is their nature? If one security is going up, will the other security go up? If it goes up, then by how many percent? Okay, and if the security is going down and another security is going up, that is, there is inverse relation, okay, there is negative relation. So how much will it go? Okay, if the security goes up by one distance and the same security B goes up by same distance, it is known as perfect correlation. Okay, so what happens, you can get any security, okay, there you won't get any diversified benefit. Okay, if you want diversification benefit, there should be some difference in security. Okay, so the same thing it is written here, that portfolio risk cannot be directly calculated as weighted average of security risk, since portfolio is diversified by investment in multiple securities. Okay, hence to calculate portfolio risk, we need to give impact of correlation between the security in the portfolio. Okay, that's what I said, that there exists some relation between it. Okay, so if I take an example, let's suppose there are two companies. Okay, one is NHPC, which is a PSU, and the next one is, let's suppose, Paytm. Both of these companies are listed in the stock exchange. Okay, that is a Bombay Stock Exchange or National Stock Exchange. Both of these securities are listed. Okay, so now what happens, when I have both the securities in my portfolio. Okay, my portfolio, I have both the securities. Okay, now what happens, when NHPC goes up, my Paytm goes down. Okay, when Paytm goes up, my NHPC goes down. Okay, so there is negative relation. Okay, so for perfect relation, if there is perfect relation, okay, perfect negative correlation, that is how much, if it is increasing by, let's suppose, 10% and it is decreasing by 10%, then it is perfect negative correlation. Okay, then that value will be 1. Okay, so correlation is denoted by R. Okay, R can be 1, -1 or 0. Okay, 0 means what? It is independent. Okay, anything can happen. And 1 and -1 matlab it is correlated. Okay, 1 and -1 matlab it is perfectly correlated. Okay, -1 matlab it is perfectly negative correlated and 1 is perfectly correlated, positively correlated. Okay, so R will be in 0 or 0.75 or 1.25. Okay, it will be in point only. Okay, so how will we calculate the correlation? Okay, so correlation of security A and B, in our case it is security NHPC and Paytm. Okay, NHPC and Paytm. So what is the correlation between it? How will we calculate? So what we do, we take both the variance, both of their variance. So what we call it? We call it covariance. Okay, and what we do, we divide it with individual securities standard deviation. Okay, that is the standard deviation of NHPC into standard deviation of Paytm. If you see, what is variance? What is variance? Variance is squared. Okay, variance is squared. What is standard deviation? Standard deviation is rooted. Okay, so this is squared. So root into root is equal to what? Square, right? So square root into square root, it becomes your kind of variance only. Okay, we take covariance divided by individual standard deviation into. Okay, so we get correlation. Now, if in question your standard deviation of both the securities given, NHPC and Paytm, and your R is given. Okay, R is given. So can you find covariance? Can you find covariance? Yes. How we can do? Covariance is equal to R into standard deviation of A into standard deviation of B. Okay, RAB is equal to COVAB is equal to RAB into standard deviation of A into standard deviation of B. Okay, so this is a formula. If you want to remember the formula, remember the formula. Okay, or else remember it logically. So here there are some notes given. Okay, correlation is calculated in numerical value. Okay, so I said that 1.25 and something, right? It won't come. Okay, 1.25 and all will not come. It will only be in, it may range between -1 to 1 only. Okay, there will be no 1.25. Okay, keep that in mind. Only -1 to 0.1. So how will its number line look like? Its number line will look like this: 0, 1, -1. Right, it will range anywhere in between this. Okay, R indicates perfect positive correlation, -1 indicates is equal to negative correlation, and 0 indicates that the securities are independent. There is no correlation between them. If correlation between security and market is given in question, then correlation will be between each securities can be as follows. What can it be? See, when we have two securities, right? NHPC and Paytm. We don't know their relation in between them. Are Paytm and NHPC. Okay, we don't know the relation between them. So what we do? We take their relation with their market. Okay, they are listed in the same market, right? So we'll take the relation between them. We'll do multiply RNM into RPM. Okay, MM gets cancelled, we get relation of them. Okay, so that's what is written here. RAB is equal to correlation between security A and B. AM is equal to correlation between security and market. Correlation between RBM is equal to correlation between security B and market. Okay, so we have a sum like that. We'll do in the next session. Covariance, as I told you, it is the joint deviation between annual returns of two securities from their respective expected return. Okay, joint deviation means what? X minus X bar, okay, of security A and X minus X bar of security B. So double time X, it is not looking nice, right? So we will denote security B as Y. Okay, Y minus Y bar. So X minus X bar into Y minus Y bar is your covariance. Okay, now covariance can also be calculated in the basis of two methods, which is your past data, that is your ex post analysis, and future data with probability, that is your ex ante analysis. Okay, so accordingly it will be summation of x minus x bar divided by n, and here we will multiply with probability. Okay. Also the alternate formula that I gave you, that is derived from here only. See, from here it is derived RAB into standard deviation of A, standard deviation of B is equal to covariance of AB. Covariance of AB is equal to standard deviation of A, standard deviation of B, relation of AB. Okay. Just remember this formula. Okay, if you can't understand the logic, just remember the formula. This R factor, it will come for risk only. Okay, we need a relation between securities only for risk. Okay, so in portfolio risk, we'll have to find out the relation between them, the correlation between them. Okay, so that's where the covariance also comes into place. Okay, there is some example given here. We will solve question only. Okay, we'll ignore this example. We have good questions. Next we have is portfolio risk. That is your variance and standard deviation of portfolio. How you will calculate that? Okay. So now let me take the same example. Okay. Let's suppose my standard deviation of security A is equal to 4%. Okay. Standard deviation of security B is equal to 5%. Okay. Now what? They both form my portfolio. Okay. They both form my portfolio. Okay. Now I need to find portfolio as a risk. So how will I find it? Basic you want R and covariance. Okay. It is just a component of it. Now we are finding the actual risk of it. So how will we find it? So what we'll do? A plus standard deviation of B, the whole square. Right? This is the formula, right? So I need their risk. Okay, so now what is it? This is my variance. Okay. This is what? This is my variance. We cannot take single figure, right? So we'll take variance of it only. Okay. Now we have variance here. Okay, now we have to just expand it. Okay. Security A. Okay. Security B plus 2 security A, security B into your RAB, or you can write it as what? COVAB. Right. So this will be a formula, right? Now what is the weight between them? We don't know the weight, right? So we don't know the weight here. So what we'll do? We'll add weight here also. Or else how can we find it? Into weight of B. See, our standard deviation is in square. So we will also need our weight also in square only. Okay. So weight of A, weight of B, okay, plus 2 into. So can you see this formula is somewhat related? A square plus B square plus 2AB, right? 2AB. So now there is no square here, right? So we will take just single figure here, and we'll take correlation extra factor, so that there is a relation between them, or we will take COVAB. Okay. Now here weight is missing. Weight of A into weight of B into standard deviation of A, standard deviation of B into their correlation, or we can simply take they are both COVAB, right? So this is the formula. Simple, quite simple. Next, now this answer will be in variance. Okay, what we need? If we need in standard deviation, we will do square root of it. Okay. Now this is for two securities. What if there are three securities? What if there are three securities? How we will do? It will be A plus B plus C the whole square. What we need? We need three securities variance. Okay, we need three securities variance. So here we take A square plus B, sorry, A plus B plus C the whole square. Okay. So what is this formula? If we take it out, how will it be? You have learned it in 8th standard. Okay, I'm just making you revise here. Okay, A square, okay, plus B square plus C square plus 2AB plus 2BC plus 2CAC, right? This is my formula. Now why the 2 factor is coming here? Because if you draw a grid, you can find it. Okay, I'm not going into the deep depth of it. Okay, so here A, B, C, and here it will be A, B, C. Okay, so A into A we don't need, A into B, B into B we don't need, C into B we don't need. So this is cancelled. So here 1, 2, 3, 4, 5, 6. There are 6 blocks, right? So we'll take relation of A with B and B with A. Okay, and C with B and A with C. Okay, like that we'll get 6 relation. So we can't take 6 here, so we'll do multiply with 3 times and we'll take unique factor only. Okay, 2 times we'll do here. Okay, this is just think of it, just remember the formula. Okay, we don't need to dive deep into this grid format, we just need the formula of here. Okay, so how will we do it? In terms of security, how we'll do? We'll take the same A into weight of A plus standard deviation of B into square and weight of B square plus standard deviation of C into weight of C square plus 2 into your what? Weight of A into weight of B into your COV AB, right? Instead of your this one standard deviation of B and RAB, I can also write it as COV AB, right? Plus 2 into weight of B into weight of C into COV BC and plus 2 into your weight of A into weight of C into 2 COV AC. Okay, this is your formula. Okay, very much simple it is. Okay, just remember A square plus B, A plus B the whole square or A plus B plus C the whole square. Okay, so that's what it is written here. We will move on to next concept. It is your minimum risk portfolio. That is your minimum variance portfolio. Okay, minimum variance means what? Minimum deviation portfolio. Okay, how much is your annual return being deviated from your expected return? Okay, so there should be minimum deviation or minimum risk or minimum variance. Okay, so how will we do it? This formula you just have to make it up. I'll just tell you the trick for it. Okay, minimum variance portfolio. How will you do it? What we need? We need a minimum variance, right? So what we need in it is we need weights. Okay, how much weight should I assign to each of the security so that I can get minimum variance? Okay, minimum risk. So how will we do it? We need what? We need weights only. Okay, so need weight of A is equal to, so what we do, standard deviation of, that is your variance of A, variance of B minus your covariance AB. Okay, next what? Next is your variance of A plus variance of B minus, we need to minus what? Their covariance between them. Okay, so this is the formula. So to remember it, what we can do, it is the others variance, okay, weight of A we took, right, the others variance, weight of B's variance minus covariance divided by both variance, add both variance minus their covariance, 2 times covariance, okay. So like this you can remember, or if you want you can follow my method. It is दूसरे का, that is your others variance minus your covariance, okay, you will get your weight, okay, divided by standard deviation of A, standard deviation of B, the whole square. So here plus 2AB will come, right? So instead of that we can write plus minus 2 minus 2 CAB, okay. So here we will not take weight because weight is being calculated here, okay, and weight of B will be 1 minus weight of A. Simple. Next we are having that in case of portfolio with 3 securities, how will we calculate weight, okay. We'll solve it with critical line equation, okay. What is critical line equation? It is, if you want weight of B is equal to A plus B into weight of A, okay. This is the formula we are going to use, okay. I'm not going to explain the derivation of it, just remember the formula, okay. Just remember the formula. It is weight of B is equal to A plus B into weight of A, okay. So in 3 securities, how will we find it? First step is to formulate 2 critical line equations by using weights of security A and B in existing minimum variance portfolio of investor for the same securities, okay. So in question they would have given the weights of securities A and B, okay, how much they have invested in it, okay, already. So what we need to do, we just need to put their weights simply, weight of security A and B, okay, just for 2 securities. In each security we put, okay. Let's suppose there are 2 portfolios, okay, we put 2 values in each of them, okay. Now we will solve the equations mathematically, okay, to find out the value of A and B, okay. So if you make 2 equations we can solve it, okay. We'll see it in question only. Then find weight of B in new minimum variance portfolio by putting the value of A and B and weight of A, which is given in question for new minimum variance portfolio. Step C, weight of C is equal to 1 minus weight of A minus weight of B, okay. We will see this in question, okay. See, if you see this in question, it will be very much easy, but this is not very much useful in exam. It was in old course, okay. In our syllabus it is not that relevant, okay. This concept is not even in module, okay. So just there is one question, so we need to solve it, okay. We'll solve it in the next lecture. I'll tell you very much how to solve it, okay. Next it is your Markowitz efficient portfolio. We do it by, there are 2 methods, okay. The first one is efficient frontier method and the second one is coefficient of variation method. So what is Markowitz saying? That we have to select efficient securities out of given number of securities to make an efficient portfolio, that is portfolio having highest return for a specific risk, okay. So what is they are saying, that they would have given some securities with predetermined predetermined risk and return. So out of that we need to find the best portfolio, best security, okay, the best security to find the best portfolio. So how will we do it? First we will compare securities having same return and select the security which is having lowest risk among them, okay. We will see securities having highest return, okay, and we will select those which are having lowest risk. Next, compare securities having same risk and security having high return among them, okay. We'll see same risk and we'll see high return among them, and then finally if required select the securities from those that have not been compared yet, okay. So first what we need to do, same return, okay, and we'll take lowest risk, okay. High return will be selected only and same return and lowest risk we'll select. Then we'll select same then we'll compare same risk pattern and we'll see return of it, okay, which is having highest return. Okay, this is one question we'll do in next lecture. You'll understand it better by doing question. Okay, next, coefficient of variation or CV method. What we do is, how much return are we earning by taking risk? Okay, standard deviation by your expected return. So that is the formula here. So here what we'll do, since above there is risk, so the lower the ratio, it is the better. Okay, lower the ratio, it is better. So above there is standard deviation and lower that is your minimum, your return. Since above is a risk factor, so lesser the ratio, lesser the risk. Okay, we'll choose the amount with lower ratio. Okay, so that's it for today. Okay, we have seen all the concepts of Markowitz modern portfolio theory. Okay, we'll solve questions in the next lecture.